Apologies on that. Sometimes technology is a little bit out of our control. But confirm that you can hear me.
No, let's speak up and we try to pick the audio. We are losing it a bit.
Can you hear me now?
Yes, the voice is a bit lower.
Oh, what about now? Apologies, guys. Can you hear me now?
Yes, carry on, carry on. That's much better.
Okay. And I know I want to benchmark on what Huzail has talked about. This is a point which many people always fear. The loan. I know he hasn't explored it in full detail, but I would believe people who are listening in, that is something they would want to take advantage of. There is always that understanding that if I have real estate, I can take it as security and I get a loan. For the first time, a bank has fully said that you can take a treasury bond and you as security. So if at any one time someone is listening in and have always wanted to understand how can I take advantage of this, that is there is no better endorsement to that. And this is not just treasury bonds for Post Bank, but when you go to any bank or to Post Bank, you can ask them, this is my I need a loan of 20 million. Can I use my bond as security? And you will always negotiate and get it right. Of we are in school fees time, we are always in some expense time. Let me call it that way for Ugandans. You must always plan for expenses. And what makes treasury bonds unique is something which we call the bond laddering. Now, that is a technical term. That is a technical term which most times in the bond language we use to say you have bonds that mature at different points in time. You have bonds that pay at different months in time. What we are trying to tell you is when you think of expenses that fall due, whatever they fall due, whether they are salaries, whether they are for companies where you know you have to pay salaries every single month, you can use your treasury bonds to invest. You can use the treasury bonds to invest. You have different bonds that pay at a different month. And then every time you get the money from the treasury bonds, you can use it to pay your salaries. That's how you want to structure your bonds. You structure based on the cash flows. To another person, they can be like, okay, I know every 6 months I need to take a holiday. It's okay. There are people who are there who know that every 6 months they have to take a holiday. And you know your holidays are in June and December. Then you plan your bonds based on that. Another person, to many of us, it's school fees. You plan based on that. So that means when you go to the bank, or when you go to an investment advisor, you have to ask them and say, okay, these are my needs, these are my what I want to achieve. Which bonds are going to pay at this point in time? Then you structure your bond portfolio based off that. Back to you, Edmund.
All right. Thank you so much. I love the concepts that you're bringing in there. Thanks for expounding on that. Gone are the days when we thought we still need to go back and look for land titles as security to acquire money from banks. Treasury bonds are here to save us. So, Husairu, I'll come to you. Every investment has risks, and treasury bonds are not any different. What are some of the risks that you can highlight for us here?
Thank you, Edmond. What can I say? When you look at the treasury bond or bill, these are instruments that are issued by the government. One of the risks that is mainly looked at in investment is credit risk that someone will not settle me or pay me. However, to counter that risk, we know these are instruments owned by the government of Uganda or any other government if you invest in securities in Tanzania. So the chance that government will default on paying you is very close to zero. So credit risk in treasury bills and bonds is close to zero because these are securities that are issued by the government of Uganda. The other risk that you can think of investment may be liquidity or cash flow risk as an individual. If maybe you went to invest in a 10-year bond and yet you have things that need cash flows. But Alex has clearly told you in the strategies, you and know that if I have to pay 6 months of 1 million, you're not to, you're not going to get that 1M and go and buy a treasury bond, which you're going to need in a month or two. So you have to know your strategies and know I have inflows and outflows. This money will be enough to cover me, and then I'll keep this for saving. And that's what we normally advise our customers to do. That we have to develop a culture of saving. You can't be earning 1M as your net salary and you want to invest it all in a security. It means you will not live. So a portion of what you earn has to be left for investment and then a portion for your normal operations. The other risk would be interest rate risk. For example, if you put a bond maybe of 15 years and the interest rate is 14%. Maybe 1 year after government issues another one and it comes at 19%. However, these are investments. One, I talked about the tax component. Tax component is a shield in terms of interest. If if I'm only taxed 10% for a long dated tenor, I'll be good to go. Then secondly, if I'm looking at other investment, because when you invest in a T bond now, you can invest in another one next month, the other month. So you have a range of investment at different rates, and then too, you're able to know your portfolio. The other thing is to know that I have part of my portfolio is in securities, government paper, part of my portfolio is in fixed deposits with us, and part of my portfolio is on Wendy savings. So you have a whole range of uh, products that are going to help you cover up your interest rates at any one point in time.
All right. Thank you, Kuzairo. And now, so those are the risks. You at Post Bank, how would you help us manage those risks as customers that would walk to you and would want to invest in these T bonds?
Thank you, Edmund. And like I've shared, what what we give to our customers is investment advisory. First of all, when a customer comes in, we make sure that we give them options. We have a fixed deposit that is close or almost the same as a treasury bond rate. You can walk into a post bank branch and we give you a rate that is close to a treasury bill rate, or we can give you another product that is close to that. So we ensure that you have the investment information on you so that by the time you make a decision, you have all the angles you're supposed to look at if you're to decide which type of investment you're supposed to take up. Then secondly, we also give the customers, there are customers that will come to you and say, I need to know how much I'm going to earn if I give you my 20M. So we have those simulations there and then with the customer. And we tell them this is how much you're going to earn when you invest 20M on a fixed deposit at this rate for this period. If you put it here, this is how much you're going to get. So we ensure that the customers are knowledgeable and they know whatever option they have to take. A customer can walk in and say, I am going to pay for school fees in 6 months. But they've come in with the mind of buying a treasury bond. So you tell them, no, if you need this money in 6 months, I have a fixed deposit, I have a flexi fixed deposit that's going to give you a 10%, a 12% in 6 months. Remember what I told you. The bank investments are more liquid. Yes, the treasury bills and bonds can be sold at any point in time. But when you look at the bank investments, when you walk in immediately, you can terminate an FD and you walk away with your money there and then. So we try and ensure that we put ourselves in the customer's shoes. We give them a whole view of your investment options so that they can make the best decision to invest.
All right. Thank you. Thank you so much. We'd like to we now know that there are investment advisory services that you offer at Postbank. Now, I would leave you at that and move on to Alex with the industry experts. What are some of the risks that you can weigh on in here in terms of treasury investments?
Uh, Thanks, Edmund. Confirm that you can hear me.
Yes, we can.
Perfect. I think the same risks which Huzail has talked about, maybe I'll talk about them from a perspective of an investor who has been in this market for now a while. I'll start with the interest rate risk and I will relate it easily. Now, there is a statement we have in the investment world that time in the market is better than timing the market. That you want to spend as much time as possible investing in the market as compared to trying to time the market. I know right now, as more people are getting interested in investing in the treasury bonds, they always come to the conclusion where they say, when am I going to get the highest interest rates? Like the last few months where we have seen 17 plus, right? And then they will wait to see if it will reach 18. Now it has surprised them, it came back to 17, where it might easily come back to around 16.5. What does that mean? That's what the point which Hazael was talking about. But when you invest, when you have the money, you invest at a bare minimum, have a threshold and say, I'm not buying a treasury bond that doesn't give me a minimum 14% gross yield. Now, when you set that benchmark, that means anything over and above is always a plus. At any one point, you're going to invest. For those of you who are entering the market and are entering in the last 2 months or 3 months, when interest rates have been as high as 17.5, when we saw a bond which had 17.8%, be sure that at one point they're going to come back to around 14, 15. That's how the bond market works. And to give you an example, just to expound, and that's why I'm saying I'm taking it from an investment perspective. In Kenya, last year, their rates reached 18% because of the factors that were playing at that time. And people invested so much. Right now, they are at 13%. But any investor who is playing the long term game will always make money. Why? Because there is compounding factor. You will always have something to invest at any point in time, even if it's that small. So you take advantage of interest rates when they are high. You also take advantage of interest rates when they are low. But you just have to keep investing. So do not be scared. Do not fear that what happens when the rates now come back to 16. Keep investing. So I wanted to kind of stretch on that. Then the last point maybe I would want to stretch on the risks is on the liquidity. Now, when you talk to an advisor, when you go to the bank and you sit down and you lay out your plans, they advise you that okay, you need this money in 6 months. It might be better to just buy a fixed deposit for 6 months. The return is this. You look at the numbers. To other people, they are not so sure when they might need the money, and that's okay. And you want to still play into the treasury bond world. If you align your goals, you're going to be like, maybe I have, let me say, a lump sum of 50 million to invest. And you might need 10 million in a year, 20 million in 3 years, 20 million, maybe you might not need it for the next 5 years. Then the prudent approach will be to deploy that money that way. You put the 10 million in a fixed deposit maturing in 1 year, put the 20 million in a 3 year bond that is maturing in 3 years, put the other 20 million in a 10-year bond that is maturing in 10 years. That way you have spread it out. Now, after 1 year, if you don't need that money anymore, you can add it onto the 2-year bond or onto the 3-year bond or onto the 10-year bond. But if at any one point you reach a level where you say, okay, I might need this money, whether all of it or some of it, you still can go to the bank and sell that bond in 48 hours, you always
Nsiba
get some of that money. So it's
bw'oba obadde
not a
teekagulayo
problem.
poloti ndala
So that,
miliyoni nga
whereas
ttaano
that
kudda
liquidity
waggulu
risk is there, with the
zinvestinge
proper
wano eno
planning,
mwene
you can
gundi gye
have a
nagambye
way to
eggulo
address it. So always it's
gulamu bondi
understanding
zo
the
boyi mu
risk
banka
and what
tojja
parameters and
kwejjusa.
what angle can you use to play around that. Thank you so much. Back to you, Edmund.
Wow, beautiful insights, Alex. Thank you so much. So I'll stick with you for a minute. I love a statement that you made while submitting. You said time in the
Olina okuba nga
market
olina akawunti kati
is
gweoba olina
better than
akawunti singa
time
ebbanka
at the market. And I want
bakuguza.
us to dwell a little on that. So yesterday, auction
Kati
results
olina akantu
issued,
gy'oddamu
and
oggulawo
we saw a drop in yield rates.
ng'okozesa akawunti eyo.
Sticking to that and the industry insights, what is your take, and how do you think, what do you think the direction is in the next couple of months?
Uh, Thank you so much, Edmund, for that. I'll start from here. For those, especially for our listeners who are entering or learning the market, there are so many factors that influence interest rates, either going up or going down. To an extent that the appointment, and this is not overstretch, but it can impact that the appointment of a full substantive governor and a deputy governor can send confidence into the industry that interest rates can react that way. Now, when you take a little bit of a step to look backwards, you can say we are in Feb 2025. In Feb 2024, when the 15-year bond at that time was issued, it had an interest rate of 16%, right? So that means a year later, the interest rates have increased up to 17% on the, let's say, on the long term, which is the 15-year bond. That's 1% over and above what it was a year ago. However, at one time, which was Jan, which is a month ago, they were at 17.5. So what I'm trying to indicate to people that interest rates are going to come up. At one point, they can come down. They will still go up at one point, depending on the factors. Now, when you look at that, then you have to project the future and say, as a country, where are we going? Now, we are Ugandans. We know in 2026 we are going into the election period. What that means is there is always a risk that is attached at the point of when you're about to enter the election period. And we have seen historically, when you go back to 2011, 2016, apart from 2021, which was a COVID year, but 2011, 2016, 2022, towards the election period, there is a little bit of a jump in interest rates from the lows of 15, 16 to where we are right now in 17. So for those of you who are trying to invest, anticipate and continue to see that interest rates are going to remain at the heightened levels of 16 plus and above. For them, for us who are investing, anything above 16 plus is it's heightened, it's good. We also don't want to break the bank of the government, you know. So 16 and above is still good. So we're going to continue seeing those going forward. However, let's not forget one important thing, especially if it materializes. As the country starts to consolidate its revenues from the oil, which means there might be a little reduction in reliance on domestic borrowing. Then, for as long as the government doesn't need so much money, that means the medium term forecast is interest rates might the quote is might start going down. So what does that mean is, in the short term, the next 12 months, as we go through the election period, you might continue seeing 16, 17%, and take advantage of that. That is a net return of around 14% plus. That means your money doubles every 5 years if you compound, right? That's what it means, actually. Even if you don't compound, you get almost 96% every 5 years. But in the medium term, to stretch it a little bit further, 2027, 2028, if indeed the oil revenue starts to flow, which means the government must start getting another source of revenue, which we are benchmarking on, and many of us as Ugandans, you should be praying that that oil revenue starts to come in, and the tax base is growing. The potential of that is that there might be a reduction in the borrowing, and that will lead to interest rates to kind of come down to maybe 13 or 14%. But still, a 14% is way much better than so many things you can get out there. Back to you, Edmund.
Wow, beautiful insights. Thank you so much, Alex. That is very informative. So I want to come to you, Huzairu. When you and Alex are submitting, you are mentioning quite a number of terms, and would like to break it down. You're talking of the coupon rates. You're talking of the net yield, the gross yield. You're talking of face value. Bringing it down to post bank. Could you take us through what each of these mean as you are pointing us to the figures that you offer at Postbank?
Thank you, Edmund. These terms are the normal terms used in these investments. When you look at what we call the face value, the face value is the value of the paper that you're buying. For example, if you're buying a treasury bond and the government says this paper is worth 100 billion, so when the interest, what we call the coupon rate, the interest, if the coupon rate is 15%, that coupon rate will be applied on that face value. So if you invest 100 million and they tell you the coupon rate is 15%, so the 15% will be subjected to that face value. And then it is the interest component that they get that will be subjected to the withholding tax. So coupon rate is the same as interest rate. And then the face value is the value of the bond.
All right. Thank you so much, Huzairu. That's helpful. So from now to our listeners, we are going to take in a few questions. Uh, for now, we have someone called Cosmas. I would like to pause it at this, and we open up the Q&A session as we come to the end of the space. Cosmas.
That's the problem. Maybe now looking for Monday. No, that doesn't know. That's a problem. Ah, now.
Edmund, can you hear me as we wait for Cosmos to come through?
Yes, Alex, I can hear you. Carry on as it comes in.
Just to just to supplement on what Fuzail has talked about on the face value, I'm going to look at it from an investor's perspective. When we talk about investing, it means you have to pay money. If let me call it cash, your actual amount you have. You want to always, the same way if I'm to use land, if you know the land value is 10 million, you either want to make sure you are paying at 10 million or negotiate downwards to let's say 9.5. So I know many people when they are investing, you will always be like, I'm buying a bond of 10 million. How come the government or the bank or Bank of Uganda has only taken off 9.5? Right? As interest rates, what we talked about, the interest rates changing up and down, the face value of the Cosmos, help me mute for a second. Thank you. As the your first value, the bond you would have bought would still be 10 million, and at maturity they will give you back the 10 million. But as interest rates change here and there, as different factors change, the actual price you end up paying might sometimes be lower than the first value, or in certain circumstances a little bit higher. So what determines that is you when you are making a decision on which bond to buy, you have to always think and anticipate, am I going to buy cheaper, which means at a discount? Am I going to buy at a premium? There are times you someone comes and they're trying to invest for a 10-year bond, 15-year bond, and you want to advise them go for this type of bond because it where it is given the interest rates as and the coupon rate as Jose explained them, you might pay a little bit more money than the face value. And that doesn't mean that at maturity they'll give you less money, they'll give you all the money. So even that strategy helps because it kind of guides you how do you invest. which bond to invest in, and even that. But overall, sometimes right now we are in a market where the rates are higher, which means you are buying majority of the bonds at a discount. At one point, they might be at a premium, which means you are paying a little bit more money than what you are getting. Oh, that should not scare an investor. Markets always change. At the end of the day, you have to compute and say, I'm investing a bond for 10 years. I'm putting in 10 million. It's going to be giving me 1.5 million every single year. They are asking me to pay premium of just 100,000. I'm going to recover that money and more in just 1 year. Do that investment. Back to you, Edmund.
Wow, thank you so much, Alex and Huzairi. Well put. Thank you so much for all the insights that you've given. I believe our listeners have gotten quite a number of insights. So I'll then call on Cosmas. You have a question. Kindly start by mentioning who the question is going to, and then proceed with the question. Okay, Ivan, are you there? I see you also have a question for us. Start by mentioning the person and then the question. All right, so I think Ivan's network is troubling him a bit.
Yes,
So
yes, Edmund.
yes, kindly take it on.
Yes, thank you so much. Thank you to Postbank for hosting, and thanks to Kakande for his insight and everyone who has contributed. My name is Ivan Kurunziza. I have about two questions. One, if I bought a bond, for example, through Postbank, maybe a bond is for 10 years, and maybe after 5 or 3 years, I would want to terminate the bond before the end of term. What are the implications? What are the charges that I maybe Postbank charges me? How much money do I get? What is the percentage that I maybe pay the bank? Do I get the whole amount of the bond, or there's a percentage I get if I decide to liquidate and get cash? Then the second question is I would want to ask maybe Mr. Alex is about the payments. The interest rate quoted, for example, 16% is always per annum, per year. But I'm aware, or I've been told that the coupon payments are always biannual, 2 times in a year. So is it 14, 16%? Maybe, for example, if it is 10 million, that is 1.6. Is it 1.6 per 6 months, or that 1.6 is split into two? So I get 800 in 6 months, and then another 800 in the other 6 months. Then finally, we realize we buy these bonds through our banks, for example, Postbank. If if maybe the government has quoted a coupon rate, for example, 16%, and maybe I'm buying through Postbank, does Postbank, do different banks also offer different coupon rates? Can they chop on that, or I get that exact coupon rate that is quoted by the government, that is quoted on the bond? Thank you so much.
Okay, thank you so much, Ivan. So we are going to start off with those directed to Huzairu. I think two of them, starting with the first. Huzairu, you can take it on.
Thank you so much, Ivan, for the questions. I'll start with the first one. If you buy a bond for maybe 10 years, but 5 years down the road, you want to sell it off, what charges does the bank have for you to get your money back? First of all, I'd like to assure you that when you buy a bond, you can get you can sell that bond to the bank at any point in time. You can actually buy it today and then even sell it tomorrow, depending on what you want or what you are foreseeing. Now, secondly, the bank does not charge anything if you're to sell a bond after you holding it. So the bank, there's no bank charge at that. However, as Alex indicated, that most of these bonds in terms of pricing will depend on different factors, market conditions. So at the point when you're selling the bond will be bought at the market price, at that current market price in terms of yield. So when you come to the bank, before you even dispose of the bond, the bank will calculate for you the amount you expected to get after sale of the bond. If you've been holding it, if you bought a bond for 10 years and you've held it for 5 years, clearly in those 5 years you will have earned interest maybe after 6 months. So you'll have good volume. So, but what you finally get on the other hand will depend on the market rates that will be applicable as at when you sell that bond. But the bank will always guide you on what you're going to get, and at some point what you might lose or what you might gain at the point of selling the bond. I hope I've answered that. Then the second question was on the coupon rate. Uh, when these bonds are issued at coupon rates that are fixed. So when you come to Post Bank, if the bond issued is at 16%, the same coupon rate will be the same that you have the bond throughout, because these coupons are not paid by the bank. The coupons are paid by the government of Uganda and its council house. So to answer you, the coupon rate will be the same. What might differ is the yield when you're buying these bonds, the yield at which you buy. Alex mentioned that today they can be at 17 and tomorrow they can be at 16.8 or 16. Now, if you have invested at the primary market, you will get the same rate across if it is primary. Now, on the secondary market, that is where you have the difference. Postbank will give you at 17, and maybe another institution will give you at 16.8. So Postbank will be better. So, but the coupon rate will be the same across the bond as long as that bond is issued.
Right. Thank you so much, Huzairu, for those responses. So you introduced new concepts of primary market and the secondary market, and you mentioned that when you were referring to Postbank. So I would like Alex to weigh in here, starting from there, and then we will also take on the question about the interest rates from Ivan.
Thank you so much, Edmund, for that. And thanks so much, Fuzail, for explaining, introducing that primary versus the secondary market. Now, I will first go back to the position of buying and selling just a little bit. Huzail has brought in the word, the yield, which gets a little bit what determines the actual price
Wewe
you
da
pay
mai
when
to
you are
hilo.
buying or
Mwana
the actual
nakuyumula
price you
asilipa.
receive when you are selling.
Atuwali wali
Now,
Obalo ndiyo china.
more
kati
often and
temayo
not, we always tell people
gatta
learn the
oli
market. I know treasury
vibes.
bonds are easy, but they're not
Shege.
that straightforward. There are things which we tell clients that, hey,
Da
if you
mai
know
wali
you want
sehemu.
to do a little bit of
Pardon my
trading,
business.
you do not understand the market, but you want to say buy and sell when you need to sell to make a profit, then the advisor will tell you
Okay.
Stay there.
it's always better to sell buy when interest rates are a little bit high. So, for example, right now when we are getting around 16.5 and above, so it means you are paid cheaper. So it means a 10-year bond. For example, let me use the 15-year bond that was sold off yesterday. It had a yield of 17. It means someone who bought a bond, like my client who bought a bond of 90 million, they paid around 84 million. It means the cost they paid was just 84 to get a face value of a 90 million bond. Now, they might want to be taking a little bit of risks here and there. And like I've anticipated that maybe in the near term, interest rates might start going down. Let's assume in 2, 3 years, interest rates yields reach, let's say, 15%. It means if they are to sell that exact bond at that point, they might get 89 or even 90 or even more. Why? Different times determine different prices. So you it's not true that every time you're going to say you're going to make a loss. No. You have to determine and target when to sell. When interest rates are going down, it means the bond you bought cheaper now is going to attract more money when someone is buying it. And we have seen it and we continue to see it in the market. So there are a few nuances that you might have to learn in that regard. On interest rates, coupon rates, yields, Ivan asked, all those rates which we quote and say 10%, 12%, 15%, we should maybe just continue adding the word per annum. They are always stated as per year. So it means when you are buying a bond and it says it has a coupon rate of 15%, it means every single 6 months you get a 7.5% at gross level. The 15% is per year. To an extent, let me actually extend it a little bit further, Edmund, and I know people might easily miss this point. When it comes to treasury bills, we have the 91 treasury bills, the 182 treasury bills, and the 364. When those rates come out, the money market yields, let's say on a 91-day treasury bill, which is 3 months, it will quote a set 12%. And sometimes people think in 91 days or 3 months, they're going to get 12% of, let's say, if they invested a million, they're going to get a profit of 1.2. No. That rate they have stated is per annum. So you have to compound the 91 days worth of the 12. The easiest is to say divide by 4. So that means the 12% you're coming to what? 4, 3%, 3%. So the 91 days you're going to get just the 3% worth of what you have invested. The 182 days you'll see its money market yield at say 14%. But you're investing for 6 months. It does not mean you're going to get 14% in the 182 days. It indicates you're going to get on average 7%, which is the 1 year divided by 2, which is the 6 months. So it's that. So every time you see those interest rates we quote, always understand these are annualized or they are per annum. Going back to the point you have brought in, you have asked me to talk about the primary market versus the secondary market. The primary market happens for treasury bonds once a month. So it is targeted. You have to know that when I'm buying directly from Bank of Uganda, it's unique, right? For anyone who wants to invest in that, it means you have to even go to the bank. You have to know what Bank of Uganda is selling and when is it selling. The calendar is there. And you fill up the particular form, you take it to Post Bank, and they will take it to Bank of Uganda for you to get a bond. The secondary market is where you play in every single arena. You can buy any bond you want, whenever you want, with however much amount you want, at any one point in the time. So the secondary market is where you can actually, let me even stretch it further to give confidence into this market. The secondary market is where you can even donate the bond, transfer by free, transfer it to your spouse, you know, and you say, okay, I've bought a bond of 20 million. Now I'm going to my in-laws. Let me take them a treasury bond transfer of 5 million. That is in the secondary market as a gift, you know. It's There is so many things that can happen in the secondary market. You can sell your bond to your friend, and you fill up specific forms, you go to Post Bank, they will facilitate that trade. So a lot of things happen. And three, the last point, understanding the market is very crucial. Whereas often the primary market has better rates, it's not always true that you will get better rates in the primary market. You have to project. And I'll give you an example, Edmund, and I know Huzail, we do this so he understands. 2 3 weeks ago, the 5-year bond, you could get it on the market, on the secondary market, at around 16.2, 16.3, even 16.4, depending on the amount of money you have. Now, so many clients sat on it. They're like, let me wait for it. It's about to come from the primary market. It came yesterday when interest rates had dropped to at least 16.2. That means someone who made a bold decision to invest 2 weeks ago, it's just 2 weeks ago, they paid less money than someone who paid right now in the primary market. So there is so many dynamics you want to put in. And three, for our colleagues and friends and everyone who is just investing 100,000, maybe you are getting it every single week. You do not need to wait for the primary market with 100,000 or 200,000. Every time you have your money, it's on their account. Go to the post bank, fill up the form, or sign the form, send it to them. The next day you have your bond. They have said when you're buying from them from the primary secondary market, they do not charge you anything. So it means if you are paid weekly and every week you can afford 100,000, why not buy that bond? You just fill up a form, they give you the rate, you fill up, the cost is nothing, and you keep accumulating. So the secondary market is the wider market. It's where you want to learn how it works, because it's where you might easily sell, you might easily buy, easily donate, and do all sorts of things that would make you more money. The primary market is good, it's the originator of bonds, and it happens once every single month. And sometimes when you want to build certain bond portfolios, the only way to get them is on the secondary market. You want to ladder those bonds is to go to the bank and say, I want to talk to a bond advisor to tell me I want this bond that pays in April and pays in October. That means they'll tell you, oh, there is this bond there that matures in 2031. You will not find it on the primary market. So you have to buy it on the secondary market. You get the rates, negotiate the deal, and execute it. So both markets are good and they're interchangeable, but learning them and investing them, like let me just say, you have to invest whether secondary or primary, you still going to make money in this.
All right. Thank you so much, Alex. I know most of our listeners are now ready to walk to the Postbank branches and get themselves a treasury bond. Colleagues, thank you so much for being here. I don't know whether Cosmas, you're now able to unmute and pass on a question. You had one for us, but I also see Danny Lee has a question for us. So, Danny. Yes, Danny?
Yes, thank you. I hope I'm clear.
Yes, you are.
Thank you so much for organizing this, and Alex for always giving us information. I've really learned about the bonds from Alex. I have a few inquiries. One is, of course, as you're always saying, that the first step is opening the SSD account. I wanted to inquire. I think last year government launched some SSD Easy Portal. I don't know if it's functional, if it's yet operational, like someone, it's an alternative to go to the bank, or if it's not yet. Then secondly, okay, it keeps talking about okay, like reinvesting the coupons. Let's say I buy a 15-year bond, and then it, every maybe after 6 months I get a coupon. Okay, there's a science that I don't understand there, where they talk about reinvesting the coupons. Or I may reach 2040 when I bought a bond that is maybe paying out in 60. How can someone go about that? Thank you.
All right. Thank you so much, Danny. Those have been Those have been captured. Alex is going to be responding to those in a bit. I also see we shall take one more from Don SM. Don, you can also give us your question.
Voilà. Bakumbe bulungi. Tagamba nsula enjala.
Yes, Don, we can. Kindly proceed.
Yeah, so my question is, I wanted the speakers who are guiding us
Teriyo
to
sasa
guide
hivi.
on investment
Sasa
strategy.
kiteziriyo.
Um, is it a good idea, because this is what I have done, to get money, to raise money by putting it into a unit trust and waiting when you have, so let's say my target is 100 million, and let's say I'm putting maybe 3 or 4 million every time in the unit, every month in the unit trust, so that I can make 100 million and then I go for a bond work,
Ego abantu
or is
bakola
it better
ssente
to
omanyi gwe abantu nga boogera
keep
miliyoni
buying
10 miliyoni
in the
200
open market
5
until I
7
get my goal? Thank you.
All right, thank you, Don. So, Alex, I think all these are directed to you. You can take on starting from Danny.
Yeah, thank you so much, Edmund. I'll start with I'll start with the person who talked about reinvestment. I will say this. Um, Investments, whereas we talk about the numbers, the 10%, 14% you might get from products like fixed deposit and treasury bonds at 13, 14%, the element we do not talk about, but we should maybe emphasize, is the human element, the behavioral aspect. Now, I can run you a perfect Excel spreadsheet that will show you what you're going to earn, and if you do ABCD, this is where you are. The question is, do you have the tenacity? Do you have the will to walk that journey where you must take specific steps to achieve what you want to achieve? When we talk about reinvestment, when it comes to treasury bonds, I'm going to use the simplest example. You have invested 10 million in a 15-year bond. It means every single year, it must give you around 1.58 per month at 1.5 million a year, which is on average around 750 gross. When you take off tax, that comes to around 685. The numbers, I don't have the numbers on my face, but that's average there, right? That 680 they are giving you every 6 months, which will be for the current bond, it will be Jan and July, it comes to your bank account. Now, remember, we talked about the strategy you do when you are investing. Some strategies require that money that when it comes, you're going to pay school fees. When it comes, you're going to go for a holiday. When it comes, you're going to do ABCD, pay school, pay salaries at home. You know, some strategies require you to wait longer. It means when that money comes, you're going to go and buy another bond. You can buy a different bond, or you can go to the bank and say, this is the bond I want. I want to accumulate this exact bond. Now, that behavioral aspect, for you to know when the money comes, I will go to Post Bank and I say, now I have 600. Maybe I've added in an extra 300, which I've earned in the last 2 months. Now I have a million. Get me this another bond. Now, it means at that point, if you started with 10 million, at the point of reinvestment, which will be in July, you will now have a bond of 11 million. The next time you are paying, you are getting a coupon. You're not going to get a coupon of 680 at net. No, you're going to get a coupon of around 720. Why? It's because you have the original 10 million and this extra amount which came as a coupon, and you used it to buy another bond. That's what we mean by reinvestment. It's not automatic for the bonds. It's behavior that you must take charge of that. And I always say, not every time you're going to reinvest it, because you might be doing that and accumulate your bond from 10 million to, let's say, 30 million. Then at one time, you're going to get a coupon of 2 million, and it is going to come at a time when you must do something. Let me even call it as wild as going for a holiday. You're like, let me first eat this money. I do not care about Kakande's reinvestment. So all of a sudden the Excel changes, but at least you would have made that decision in knowing that by eating this 2 million, I'm eating away what would have brought me a little bit more money. The alternatively, what I've seen what people do, they will be like, Alex, I will invest. How much am I be going to get every? If I'm investing 10 million, I'm going to be getting 680 per every 6 months. Allow me to eat my 80K. I need to enjoy this money. I will invest 600. So you kind of have that zeal that okay, at least I'm eating some of this money as it comes, but I'm also deploying 90% of it to go back and make more money. So if you want to take charge and make as much money as possible, in finance we call it that compounding element. In the bonds world, when you're investing in treasury bonds, it's not automatic. It has a little bit of money, but it's good. Now, even if you're doing a fixed deposit, when it matures, like oh, it has I put in 10 million, they have given me 1 million after 1 year, which is the 10%. You're like, do I need it? Should I go and eat this money? No. Now reinvest the 11 million. The next year they're going to give you a little bit more money. That behavior is what matters. It's as important as what the numbers we are talking about. So it's that um, it's that important. Now going to the question of Don, where you say is it strategic? Now everything goes back to the numbers. Now, I know I'm not presenting, but if I'm to present, I will say to you, if you are to put, let me use the standard savings account. If you are to put 100,000 every single month in a savings account to earn it, let's say 2-3%, or to stretch it further to what Don talked about, 100,000 and you accumulate it in one of the other products, investment products. So they are giving you what, 11%? That's good. It's much better than you keeping the money on your in your trousers. The question you have to look back and say, if I'm to get that 100,000 and I go to Post Bank every single month and I buy a long-term bond, let's say you want to invest for 10 years, what are the numbers going to look like after a year? Compare that. However, when you are comparing that, you have to also to take an element of what Hosail talked about earlier, the liquidity element. There are times when it matters that you're going to say, I have 100,000, I'm going to buy a bond every 3 months, and the fourth month, I'm going to be buying something that is easily liquidable, which is in this case, let's say for Post Bank, is their fixed Ofrex fixed deposits. There, you come up with a strategy that allows you to put some money in a product that you can easily get your money out when you need it for emergencies of anything, as the other makes more money. From numbers perspective, if you if I'm to just give a blanket advisory, and this is not investment advisory but a blanket assessment, someone who deliberately gets whatever they can, for as long as you have jumped the 100 grand and you put it in a bond and leave it over time, even if you just keep buying one type of bond over a 10-year period, you might be much better off than someone who first puts it in one product. And but there are so many other factors we would have to look at for us to come to a position to say you are better, do it or do that. There are so many other factors we have to look at when you're doing that investment advisory. But it all goes back to the numbers.
Wow, thank you so much, Alex,
Uh,
industry expert.
uh,
Right, so
before
at this
you,
point, would like to close. Alex, thank you so much. Would like you to. I'll stick with you for a moment. You give us your parting shots and advice you would have for a potential investor in treasury out there.
Thank you so much, Edman, and thank you so much to the so many people who have tuned in. As we continue talking about treasury bonds, I do not want to say it's the future only, but at least I know it's picking up pace. 2-3 years ago, the retail investors only held around the 2%. The numbers right now, it shows they are holding close to 6-7%. It can only get better. Invest, go to those different banks, talk to the advisors, go to Post Bank, talk to their investment advisor, look for your investment advisor, read as much as possible. I write about treasury bonds almost every single week. So for you who is listening in and you don't know where to find it, when you go to my profile, there is a link on that profile that you can click. It will take you to over 300 articles that have already been published about investments, and majority of them are about treasury bonds. There is so much to learn. There is so much to earn. I repeat, there is so much to learn, but there is so much to earn. So you want to take advantage of that. And my last statement is, do not try to time the market. Stay in the market, keep investing. Majority of us will make money through a compounded effort of investing rather than keeping the money in a safe and waiting for interest rates to reach 18%. They might not be there. Someone who invests right now and they start eating the little they can, or compounding the whatever comes, will make more money. Thank you so much, Edmund, and thanks so much for Postbank for having me.
Right. Thank you so much, Alex. Mr. Alex Kakande, a financial and investment analyst there. So, Hosairu, I'll come to you for your parting shots and advice to potential investors and Postbank customers out there.
Thank you so much, Edmund. Thank you so much, Alex, for the information. To the listeners out there, you've heard our presentation this evening. You can walk into any Postbank branch. You can participate in all the investment products I've talked about. We have the fixed deposits for both local currency and FCY. We have the Flexi FD, as I explained. We have the call deposits. We have the Wendy mobile wallet that has a savings product that where you earn interest on a daily basis. So as Alex mentioned, 100,000 is the minimum amount. So you can put on Wendy saving until when you reach that. So we thank you for listening in, and Postbank is right open for you to come and we address your questions.
All right. Thank you so much, Mr. Hosairu Ruhiga, head of financial markets at Postbank. To our dear listeners, I would like to thank you so much for being with us for the past 1.5 hours. We hope that you are ready to reach out to Postbank and increase on your revenue and income streams as you invest in these treasury bonds and bills. To Mr. Alex Kakande, thank you so much for being with us today. We appreciate you. And Mr. Huzairu Iga, Asante Sana. See you all on the next X Spaces.
Esazwa abana sada tuchilinga tunachikola nje ndachikola nje